Hey, Daniel, how are you today?
I'm doing well. Thank you, Jan. Welcome everybody to the Investing Counterpoint episode for August 3rd. We'll talk about last week events. I mean, a lot has transpired since our last show, and it has direct relation to what we talked about. So we'll talk about that. So first, I mean, I'll get right into it, Jan. Well, the last couple of shows we prepared financial advisors to create scenarios to manage risk for their clients, right? And scenarios we talked about are stagflation, yield curve inversion. Most of them are recessionary type scenarios, and then last call we talked about Snap's earnings and some tech earnings that were
Mm-hmm.
horrible, and all of a sudden Google comes out with great earnings, and then a few other tech firms do well, and also Chairman Powell makes a few comments that market interprets like we're basically, we may stop the hiking, we may stop the pain much sooner, right? That's the way market interpreted it. Fed ends all the forward guidance. I don't know what that's about. I think they're just tired of misinterpretation or something. And so all these things happen, and the market has this amazing rally, quite the opposite of the scenarios that we discussed. So, what do you say? Should advisors stop doing these stagflation and yield curve inversion, recessionary scenarios, and think about the good old times?
I think you just stop all risk management and just think about bull markets ahead. No, it's this is part of it, right? This is part of what happens. I mean, every advisor that's been in the business for any length of time knows that these are parts of the ups and downs. And risk management, is not about getting the down exactly right or predicting the right time for the down, right? Just because you start running scenarios that are talking about an inverted yield curve, well, the yield curve is actually still inverted, but it might not be playing out the way that you want to. It's more inverted now than it was 2 weeks ago. It's actually a really funny shape right now. But 2 weeks does not make a trend. 2 weeks does not make a different market. And market reactions, if you go back to 2008, you go back to 2002, basically any recession or any real bear market environment, you have these fits and starts where the market goes down, comes back up. Sometimes it's
And
called
there's even a term, bear market trap. I don't know if it is one, but there is a term for these things.
Yeah, absolutely. And so, I mean, I think the important thing is to realize is that you're not and this is in our software. One of the important things that we do is we don't just have scenarios where your portfolios go down. We have scenarios where your portfolio goes up, because part of managing risk, yes, it's the downside, but you also have to understand what you're doing to the upside, because if all you were concerned about is managing the downside, you'd just be in, well, I mean, cash is a negative real return, but you'd be in a very, very conservative portfolio. So you never have these drawdowns. The reality is you have to make sure that you're comfortable with the lack of upside that you'll be getting in the event that if you prepare for that stagflationary environment and you have a market like this, where things start to rally. Are you comfortable with being behind because you believe in the long term what the thesis is behind behind the inverted yield curve, behind the slowing GDP, behind the Fed continuing to raise rates and maybe not being able to stop inflation as quickly as possible? So managing risk is always a give and take. You're not there's costs involved, and that's really what we're trying to get across here. Is I think that the concept of the cost of managing risk. There's always a price.
Yeah, and I encourage all the viewers and listeners to listen to previous episodes from the last couple of weeks. It's definitely not out of the question that this will happen. You need to prepare these stress tests. In fact, the whole point of stress testing is that you do it in good times. When in fact the event is already happening, it's kind of too late. Usually the cost of trying to do something about a stress test, about a result for the stress test, is just too high. So yes, we had some good earnings from tech companies, and we're not doom and gloomers. We just want to make sure that you are prepared for all types of scenarios and that your clients are actually able to support themselves in retirement. I mean, because we're in a retirement crisis in this country, and partly it's it's for many reasons, right? Not because of necessarily bad risk management, but bad risk management could contribute to this. if we get into a situation where some of these scenarios play out that we modeled in the previous show and the show before, your clients will be hurting. Many people will be in pain. So we want to make sure that you build robust portfolios that can capitalize on different scenarios. And my thought about what's happened is that, I don't know if it's a bear market rally. I'm not a fund manager. I'm not an active hedge fund manager that needs to make these decisions. Risk management is about preparing. But what I do say is that the biggest part of this rally, I think, is quite frankly misinterpretation of what the Fed is even saying. I think that the Fed officials have been vehemently trying to dissuade the market from making the conclusions that it seemed, market, whatever that means, right? From the conclusions that all of a sudden that we're less hawkish or the rates will not be increased. I think that there's nothing that even says that. I mean, you can't really, inflation, market participants somehow believed that we will now need fewer rate hikes. But that's lunacy. I mean, even according to the current CPI calculation, which is very, very flawed, inflation rate is like 8-9%. A 2% interest rate, or even a 3.5% interest rate, or a 4.5% interest rate for that matter, is not going to be neutral. It is still going to be negative real rate. And
Right.
you cannot stop inflation until your real rate is positive. Not even neutral. You have to crush it, right? There has to be like a kind of a, not necessarily a crash, but a bad drop. So I think what we're seeing today, right? For the longest time, I complained that the Fed has distorted the price of money, distorted many relationships. But today we're already on the next level of problems where I think these computer algorithms, they have a life of their own. A lot of them, they just, it's like, John Maynard Keynes said, in the financial markets, we're not deciding, it's like a beauty contest, but we're not deciding who's the most beautiful. We're trying to understand what others will decide, right? Who everybody else will pick as the most beautiful. And then there could be a second order of this game, right? Now I'm thinking not about what everybody thinks who is the most beautiful, but what everybody thinks about what everybody thinks.
Right.
And then you can have a third and fourth level of this. And the problem is that these computer algorithms are so fast, they need to act so fast that any move to one side, any little interpretation to one side immediately gets blown out. It's like a highly fragile system. And the other thing is, if you think about these algorithms, they're trained on data. Have they ever seen anything in data other than Fed capitulating to any market whim? They have not seen it. These are algorithms that have not seen the real world. They only seen one side. So to them, good news is good news. Bad news is good news. Everything
Right.
is good news. They're just looking for an excuse. And I think that's dangerous. I think for your clients as a financial advisor, you need to temper the news flow. And you need to say, we have a long-term goal. We're not trying to be doom and gloom, but we need to be protected in all scenarios. So I think that what we're seeing today is a misinterpretation, and even the Fed is trying to backtrack because they simply cannot. They cannot stop inflation without breaking this market to some degree. I contend that they will break the economy too. Well, it's already on the way, I think. But and that's what people need to understand, that the market of today, when it starts going up, it's not like a rational decision by many independent analysts. If there ever was such a market, it's not today. Today, it's like you get some news, some big time algos interpret it as bullish, and then the others just look to them, and of course, all they know is bullish because that's the data that they have. They never studied, history before 2010.
Yeah, but I mean, this has been going on for a long time, in arguably for years in this rally, and that's what you're talking about. You get these drops, and then all of a sudden it's a bull market. I mean, if you just think back to COVID, right? When that hit, you had this big decrease that was maybe 30 days long before you're out of the, before your bottom has made up almost all of your gains. It's so fast.
But there was no inflation. That's a big Big
No,
difference.
I do. I understand that, but there's also the idea that there were plenty of economic variables there that were pointing to a bigger drawdown. And then when you look back and you say, oh, well, this whole new paradigm shift of people working from home, it spurred all these other, efficiencies that weren't realized. People were buying, people were spending money in this different place, all the stimulus. And so there's this big bear market. So if you were only preparing for the gloom of, a pandemic, then you miss the bright spot. And I think that it's really important, regardless of whether or not you think that the Fed is going to be able to control inflation, is going to be able to do enough, is going to be able to get in front of this, is going to not wreck the economy. You need to be looking at the idea that you're wrong. Just like, if there's downside scenarios that you don't agree with, you need to look at like, well, what happens if this doesn't come to fruition for the next 3 years and that this is a bull market for the next 3 years? What does your portfolio look like? And are you and your clients comfortable with that? Because that's part of this whole risk management thing, is getting that balance between protecting yourself on the downside, being right on your scenarios, encapsulating some scenarios that maybe you don't fully agree with, but would you be okay in those scenarios? But also, how do you do on the upside? Because you can't just, your clients are not going to be happy if markets are up 25% from here and they're up 5%, because you position them to be completely protected in a stagflationary environment that doesn't come to fruition. So you have to have a balance.
Yeah, and like I said, look at the last couple of shows where we did very detailed breakdown of stress tests. We're not going to do them today. Next show, we're going to do some a breakdown of more kinds of stress tests and how to position your portfolio possibly for different scenarios. But I read some interesting notes the other day that one economist wrote that, the goal of the Fed, if you just look at the supply and demand in the market, is to essentially crush demand, right? They need to crash demand, but they need to crush it so that it's not like a depression and it doesn't last for too long, right, and then it recovers. But the question
you need to gently crush it.
What? Sorry?
They need to gently crush it.
They need to gently crush it, whatever that means, right?
Exactly.
We need to think of that word, yeah, whatever. But the question that was asked in that note is, what if they're not able? What if while they're gently crushing it, supply contracts further?
Yeah.
Meaning that the goalpost of crushing inflation gets further and further away. And that, I think, that is why people don't understand how pernicious inflation is. It is not, it's not static. It's not like, hey, we have inflation of 9-10%, which is already horrible. Mm-hmm. That is the highest inflation we had in, I don't know, 3-4 decades.
Yeah.
But the thing about it is, you can think, okay, we have 9%. So we have to move here, but the economy is not static. As you're trying to crush demand quickly and move there, supply may do things that you don't expect. Geopolitics may do things you don't expect. So therefore, again, your positioning for your clients, this is not just a show about the markets. This is a show about protecting your clients, protecting their retirement, because you can have a portfolio that is not positioned for some of these events, right? And we're not advocating totally defensive, low yield portfolios. That is not a good idea. What we're trying to say is that you need to pick your bets in a portfolio. If you're looking at the stress test and some position is contributing a big loss in some scenarios, it is fine, as long as you make sure that this position is the one you want, that you believe that it's going to do well in some other scenarios. So you have to be very intentional about building portfolio for your clients. And I believe that those advisors that care about this, that will listen to this show or do other homework on risk management, very soon your time will come. Your time will come where you're going to shine. And it's not going to be because you sold everything at the right time and went to cash or whatever. It is because you've created a portfolio that will be robust enough to withstand many different hits.
That's right. Exactly. And that's exactly right. Yep.
So the other danger that I read about, and I've been reading notes from different analysts that, most of the analysts, unfortunately, are not that useful these days. I mean, they're just kind of herd mentality, but there are some really good ones, and I'm going to be naming them. I don't have the names in front of me now, but I'm going to be giving credit to them. One of them has said that, one scenario you should think about, and you mentioned this earlier, Jan, is One stress scenario you should think about is runaway bull market, like a melt up scenario. What happens if the Fed really missteps and instead of gently crushing demand, pours some gasoline on the fire somehow? Now, it's unlikely, but what would happen to these algorithms? I mean, look, basically, in a scenario where we're technically in a recession, we have the second negative quarter of GDP that always is considered recession. We have some bad earnings. Yes, we have some good earnings, but we also have some bad signs. We have high inflation that shows no sign of abating. So there are some negative things. All it takes is a couple of companies releasing kind of strong earnings and Fed making some ambiguous statements for these algorithms to just melt up like this. Now, what happens if there's some real good news? I mean, these algorithms could melt up very quickly. So you need to think about that. Okay, out of the assets that will do reasonably well in these bad scenarios, are there some of them that will also do well in this melt up scenario? Because you don't want to be left behind. That's also a risk. If there's a big melt up and you're positioned very, very defensively, and you have no way to participate in that, your client will be also very upset, right? Because you lose purchasing power and so on. So probably next call we do, right, we're going to talk about this melt up scenario. We're going to try to show a portfolio that is positioned for different types of scenarios and will do well, reasonably well in all of them. What do you think about this melt up?
Yeah, I mean, I think that's one of the differences between, your strategic asset allocation and a dynamic asset allocation, right? So, your strategic asset allocation generally, not everybody uses this kind of nomenclature or this kind of, practice, but it's something that I always think about. Is something that I've always done. Is you have something that your portfolio is supposed to look like. This is your kind of your target, your benchmark, if you will. And it's not just a 60-40 portfolio or some kind of generic benchmark, but it's something that you have created to do well in this up and down environment. But one of the things that you have to do is you're going to probably vary from that, right? That's called your dynamic asset allocation. How do you vary from that strategic? And, you need to make sure that those bets that you're taking away from strategic, even if it's a naive benchmark, like a 60-40 benchmark, you need to make sure that those are intentional. Like you were saying, Daniel, like make sure that the biggest bets that you're taking are the ones paying off in the bull market. And if they're getting hurt in the bear market scenarios, make sure that you have the conviction to hold those. But we can talk more about that in future episodes too, because I think it's a very important, kind of looking at how your portfolio is positioned relative to benchmark or passive portfolios.
Yeah, the goal of our show is to help you manage risk for your clients, but not only that, is to help you communicate that professionally. Because we work with advisors that want to be at the top of their game. The goal is not just to be like everybody else, but to actually communicate things and teach clients about things that that they don't understand, right? Be an educator. Because when you're an educator, not just, an occasional advisor, like a true, educator is really a trusted advisor, then you're going to win and keep business. And that's our goal, is through this turbulent time to help you stay long-term, stay focused, stay intentional with your portfolio.
Yep, absolutely.
Well, thank you, everybody. We'll see you next week. We'll see where the market turns, but most importantly, we'll go over some more different kinds of stress tests and talk about building a robust portfolio for the clients.
Absolutely. All right, Daniel. Have a good weekend.
Bye. Take care, everybody.